Good afternoon, everyone. Welcome to today's webinar, Bell Curve Trading Methodology and How It Applies to the S&P, Gold, and Dollar-Yen markets. Today's presenter is Joe Musolino, President of Bell Curve Trading. Welcome, Joe.
Nice to be here.
Thank you. My name is Tom Hartle. I am CQG's Director of Product Training. I'll be your host and moderator today. Before we get started, I want to mention a few housekeeping items. If you have any questions during the webinar, please enter them into the Q&A section window at any time during the presentation, and we will have Joe answer the questions at the end of the webinar. If you're viewing the presentation in full screen, you can find the Q&A in the WebEx toolbar at the top of your screen in the drop-down menu on the far right. If you're having any sound issues, please contact the host via WebEx chat. We'll be recording today's webinar, and it will be posted within 48 hours to the events section on news.cqg.com. All registered attendees will receive an email with a link to the recording. In addition, each attendee who's not already a current subscriber will be provided a free 30-day trial of Bell Curve Trading system, along with access to the Bell Curve Trading Executive Team for questions and training. Now it's my pleasure to introduce Joe Musolino. Joe is President of Bell Curve Trading. He's the founder and developer of the Bell Curve Trading Supply and Demand Methodology, which they have used for more than 25 years. They use their methodology across all asset classes. Joe's career includes positions as a hedge fund manager, trader, and institutional broker. He is known by the trading and asset managing community through his writings and his seminars. Bell Curve Trading market calls have appeared on major business networks such as Bloomberg, BNN, and CNBC. Welcome, Joe. Now it's my pleasure to turn the webinar over to you.
Tom, I appreciate that nice introduction. Good afternoon.
Speak up just a little bit louder for us, Joe, please.
Okay, you can hear me, just need me louder? How's that? Is that better?
Oh, yeah, that's great. Thank you.
Okay. Good afternoon, and Tom, thank you for that nice intro. I want to thank everybody who is attending the current webinar. We appreciate this. This is actually the second one we've done with CQG. I also want to thank CQG as they've been supporting me since basically 1990, following us basically all around the country and internationally in London, where we've done numerous seminars. So hopefully this will be informative. We're going to go over a quick methodology setup, go over some current markets, and we had some great moves with Janet Yellen talking today. So hopefully that'll help as you move on in the next few days. Okay, overview. First thing we're going to do is talk a little bit about, Bell Curve, who we are. We're going to talk about our methodology, which is a proprietary methodology. If you have not heard anything from myself and Bell Curve Trading, that means you have not. What you're about to see will be new. The other thing we'll do is we're going to show you how good statistical technical analysis has similarities. We'll show you the methodology of Bell Curve, and we show you some of your traditional technical analysis, show where they are similarities, but also show how the Bell Curve takes a 360-degree view of all the markets. Then we'll get into the stuff that you guys want to hear the most, which is we're going to review our S&P, our gold, and our dollar-yen market. When Bell Curve does anything, we do everything in a long-term, intermediate term, and short-term. And so we're going to review up to date where we currently are in those three markets, and then we'll go through a quick Q&A. Okay. As I spoke, we've been doing this for quite a while. Who are our customers? Our customers are you guys. And it's also the professional trading community. I said we've been doing this for quite some time. What do we put out? We put out letters. That's how people know us. They subscribe to our service. We put out daily letters, weekly letters, And to give you an idea, we have no contracts with any of our customers, and we've been in business since 1998. We also do seminars, we do consulting, and there's our website. Who are our customers? You guys who are on with us right now, individuals and day traders, hedge funds, pension funds, mutual funds, exchanges, and investment banks. You may say, how can you take care of all those different time frames? That's why we put out a long term, an intermediate term, and a short term. The exchanges have been our customers because they've asked us to come and teach guys as they came off the floor, and we've done that for a number of years. So we are the broad range, and we should be able to help you in any time frame that currently suits you. Scope. What do we cover? Well, we cover basically all the major asset classes. Anywhere we can get a great set of historical pricing and exchanges, we're able to use our methodology. Currently, we analyze over 40 different markets. Well, Joe, why don't you do 140? Well, we're basically mercenaries, and we get paid for doing these 40. Also, you got to understand this is not a black box optimizing system. We don't optimize. We don't form fit. We serve basically over 20 countries. Bell curve. Well, everybody knows what a bell curve looks like. Hence, you're going to see that's our logo. And because of that, the number one and two things we look at are supply and demand. And we believe that we are really the only true supply and demand methodology guy out there. That's all we look at. We don't go by anything else but by the statistical supply and demand bell curves and methodology we're going to begin to show you today. Supply and demand advantages. Why do we think that our methodology, what is it going to do for you? Well, first off, we believe we show you where the commercial activity is, where the largest guys in the world are, and what their portfolios look like. We then trade with them. We don't trade against them, we trade with them, and we watch how the money flows amongst the largest guys. What does that allow us? Well, that gives us faster recognition of trending and trading range markets. We also give you, when you come with us, solid risk and reward opportunities. We will give you objectives in the market, but not only in price, we will also give you timing objectives. Faster identification. Well, if you can give timing objectives, we can tell you how you have increasing position risk. If we're in a position too long, and we statistically see that that position is in a 50-50 position, we're going to get out of that. It could still go in the direction we want. It may go against us. But we are not in the business of doing 50-50 trades. And if you say, gee, how do you guys do that? That's part of what we're going to show you. We're not a black box system. And to be quite honest, we think that's an absolute strength. We don't have to form fit. We don't have to optimize. We don't have to have 3, 4, 5, and 6 different variations. It's supply and demand. It's about what the portfolios of the largest guys in the world look like. And there is no form fitting. We actually believe that's a strength. Okay, a couple of simple terms, but we will take them to a level that you have not seen. What do I mean by that? Markets are either balancing, which is a trading market, or markets are unbalanced. Pretty simple. As they move to a new distribution or a new curve, we call those trending markets. Markets balance both in price and time. Once again, that's a very simple concept, but we're going to show you things in price and time that you probably have never seen as we move on. Okay, how do traders use us at Bell Curve? Well, different ways. One is, we go to different places around the world and we give full-day seminars. We also are invited into our customers and we give them to, either the banks and the investment bankers or even an individual. Once again, we talked about our letters. The other thing that we do is we're always available for questions and feedback. There's 5 of us. We have George Flynn's over in South Carolina. Bill Cerzullo is up in Boston, and sometimes you'll see him on CNBC. He's our rock star. And also Tim Hayes. So we can help in any way, and people are always emailing us and asking us for questions. So it's not like you get these letters, and then what happens? There's nobody there? No, we're answering questions all the time and giving you feedback. Okay, one of the things we must do is we gotta give a shout out to Peter Stenelmeyer, because he's the guy, we use the market profile graphical formations. And Peter did this, I guess, probably in the early 80s. And we use that graphical formation for our methodology. And we want to thank him for that. I'm going to move on. This is just the definitions of what we use. I'm going to show it to you. Here's the market profile setup. For those of you who have been through this, we're going to run through this fairly quickly. For those who haven't, that's why we're going to do this. As you can see, we look at the B period prices. They trade from 9:30 to 10 a.m. So on your typical bar chart, you would have a high and a low. Well, in this case, we have a high and a low, but we put Bs in there, or CQG does. The next 30-minute, and this is a 30-minute Dow chart as you look from up top. The next is the C period. They trade from 10 to 10:30. So there's C. There's your high, there's your low. And then you do D, 10:30 to 11. And this is how you form your charts. Now, this is no different than a bar chart. We take all those, and we take all those letters and do what? Move them over to the y-axis, and we get what? We begin to create our curves. So there's nothing different than what you guys use when you use a bar chart, and those who use market profile, we're going to show you how you can use this to make money. Okay, once again, one thing I was from the service, so I've always been able to use the KISS method, which is basically keep it simple, stupid. Okay, we have two more terms, balanced and unbalanced. Supply and demand, balanced and unbalanced. Those are the key concepts of the market profile terminology. Well, as you see, there's 3 modes of central tendency that we use. And you might say, oh my goodness, where am I? Back in statistics class. And that's exactly right. That's all we look at. We're only looking at the mean, mode, and median. We call them differently to help, and that's basically we use the mathematical mid-range, we use our high volume price, and the TPO balance point. No different than the mean, mode, and median. These are the 3 modes of central tendency. And the funny thing is a few minutes ago I was listening to Janet Yellen, and she was giving us all the different things she looks at, and she was talking about she's checking on all the central tendencies to be able to form their opinions. Well, we also look at them, but in a slightly different way. Okay, what do we have here? Well, the first thing I would ask you guys, as you see this large bell curve sitting here vertically, is would you consider this a balanced market or a market that's unbalanced? Well, if you look up at top, it says U.S. dollar yen balanced market. Okay, so this is what we would consider a balanced market. Well, gee, Joe, what are the parts of the things that tell us that this thing is balanced? Well, let's take a look. We can look back at our 3 central tendencies. The high volume price, over at the 118.50 level. The mathematical mid-range, which is at 120, and the TPO balance point, mean mode median, are all at the same level, basically at the 120. This is a very balanced curve, in our opinion. Also, if you take this curve, you take those prices that are currently on the vertical and move them to the horizontal, what do you have? You now have a volatility curve. You have a volatility curve with skews. The statistics we're going to show you, mean mode median, and also goes right along with the Black-Scholes, is the same way you calculate volatility. And we're going to show you how that works as we move on. Okay. Now, in these slides here, I've got a couple of strange-looking things on this dollar-yen slide. And I'm going to ask everybody a question. You're not going to answer me now. You can certainly ask the questions later. Is, what are the two most important numbers in mathematics? And here they are. They're in front of you. 0 and infinity. Gee, Joe, that's okay. So what the heck do you mean by that? Well, if you know where 0 is in the world, and as a supply and demand trader, that's very important to me, and I know where infinity is, if you're going to make a system or a black box, all the other answers are just a subset between 0 and infinity. So when you look at all the statistical models out there, that's the only thing they're calculating. Well, Joe, how do you mean by that? Well, when you are sitting in, you probably have heard this, but let's take a look at infinity. When you are looking at infinity, you've probably heard other people talk about where do you think the market's going to go? And they go, well, we look at it going to the second standard deviation. Well, what is the second standard deviation? That's the mathematical way that we sit and we do what? The way we are able to calculate infinity. Because you have the second, the third, the fourth, the fifth. There is no end to it. But that's mathematically how you calculate it. Okay? We also call those extremes. We start our markets at infinity or extremes, and you do. And so does most of the statistical models. So when you see our charts, you'll see that we do start at those levels. Now, there's another level there, and there's this big 0 there. Well, this is something we do that you most likely don't do. We start our curves when we know and we calculate the supply and demand over that particular period of time has reached 0. So when you look at our stuff, you'll see stuff begin, in this case, right around that 120 level. Okay, that's indicated there with the 0. Let's see if I can even put a little line in here. I can. Right in there. Now, why is that important for a supply and demand trader to know where 0 is? Well, if I can start something at 0, it's a supply and demand chart, what can I do? I can start a brand new curve. When we at Bell Curve show you curves that we use, we just don't take haphazard days. We can't just sit there and take 3 days, 5 days, take a bunch of curves, put them together, use a month or a week. We can't do that. The market tells us exactly where we start our curves, only at 0 and infinity. All right, so I'm going to give you a chance to think about that a little bit. Okay. The next slide. What we're showing you here is just a simple bar chart of natural gas, for example. There's our low and there's our high, as marked on there. But you can also look at that as being infinity. And then the other thing we showed you here in this particular diagram is where 0 is. That sideways activity, we have calculated that over that particular period of time that the supply and demand of the volume of the largest guys is 0. Hence, we know that the next large breakout from this setup is going to start there. You may ask yourself, Joe, so are you telling me that when markets consolidate, that's an important piece of info for you guys at Bell Curve? And we say absolutely. Sideways markets, quiet markets, the way they distribute is actually the market turning to zero. And that's a very important thing. And also, as we find these consolidation markets, it makes it easier for you as a trader to trade. Why is that? Because time slows down for you. You know what to look for and where to look for it. And that's one of the keys of what helps us as we trade on. Let me go on to the next chart and see if we can continue to embellish a little bit more what we're looking at. Here is that same curve from dollar yen that I had shown you. Now, what we're going to do is, we know this is a balanced market, but we're going to show you what we at Bell Curve currently are doing in our dollar yen world, why we started where we started. If I'm going to start a new long term, I'm going to say, hey, look at this curve. I believe that a new intermediate or long-term move is going to begin from the 118 to 120 level. Okay? It's going to last some 7 to 5 years. And it's going to take this market down into the 50 level. Or it's going to take this market, it could be a bullish breakout. But we know where it's going to begin. So let's take a look at what we have. The curve you just saw is the bell curve of this bar chart that you currently see. Now on this bar chart, you may sit here and say, hey Joe, I can draw a trend line from the top down and one from the up, and I have a wedge pattern. And I'm going to tell you that's correct. Remember, good technical analysis has similar things. And that's one of the things. You could be using a trend line set up here. You could be using stochastics. You could be using maybe Bollinger Bands. Well, they're going to tell you that this market is about to break out, that the volatilities are low, that the market is in an area where a potential breakout. Well, we also show that. Okay. Now I'm moving on to, this is current charts that we use at Bell Curve. We say that the newest breakout in dollar yen happened in July 07. If you take a look at that very bottom, you'll have dates: April 1990, July 07, Sep 12, and Jan 14. Just focus on this July 07 curve. That's our breakout. We've been looking at this breakout since July of 07. Where did it start from? The 0 point. That's the only place you can start these curves. Okay? One of the problems with most technical analysis is that you have a running technical analysis and you don't know where it begins. So if you have no beginning, you really have no ending in your analysis. Okay? This is why statistically, when you use Black-Scholes and you have in the black boxes, they have an ending and a beginning, which are 0 and infinity. Okay. We look at this July 07 curve. Hey, look at that, Joe. It started right from your 120 level. Now, on that 07 curve, or all the curves there, you have these green lines. What are they? Those are the mathematical mid-ranges of all those particular curves. It's an extremely important piece of info for us. We always need to know where the mathematical mid-range is. Why? Because that's where math says fair price is. And we want to take a look, hey, what's the difference between what math says is fair and what the market says is fair? So in 07, we say, hey, we have an unbalanced curve. It's going to go down to close to the 56 to 60 level. Bottom of value of this curve on the left from April 1990 is around par. So this new 07 curve, you know, top of value should be around par. And that's what's happened. You can see that in September, the market rallied. And where did it rally back to? Is it a shock? To the high volume price of the old April 90 curve. And we recently, that was been our big sell area, and we recently be able to sell there. We did get a nice pop back up into the 102.50 level today off of Janet Yellen's testimony, and we'll kind of show you where we are as the day goes on. Okay. Remember, there's two kinds of markets, balanced and unbalanced. So I just show you how we take a balanced curve and start a new unbalanced market. Well, here's a curve. This is happens to be the June U.S. dollar 10-year. And this curve has an imbalance. It definitely looks different than the curve you had seen. Well, what's the imbalance about it? Well, a couple things. One is, as you can see, the mathematical mid-range here is 115.01. The high volume price in this case is 116 even. So they're no longer all together. These are now different. The difference between 115.01, where math says is fair price, and 116 even, which is what the market says is fair price, is different. That difference is the supply and demand imbalance in the market. We then calculate that supply and demand imbalance to be able to get the objective. When we calculate that, what objective do we get? Well, believe it or not, you get the second standard deviation. And this is how all the statistical models work. In this case, this is actually showing us an objective around the 118.12. We'll show you how you get to that level. All right. Now, a couple things. If you look at over to the left side, I'm going to put a little arrow. You can see this small little distribution. Okay. Next, I'm going to show you another arrow. You see a second arrow here, a second distribution. Now, I'm telling you when mathematical mid-range is at 115.01 and the high volume is at 116 even, that's a bullish curve. We now look at those two distributions. Which one is larger? Well, the one up here, the green one, is larger than the red one below. What does that tell you? That tells you that there's more volume up at the 115.20 than there is at 115.8. Well, that tells you that volume is moving up as price is moving up. Now we look up at the next one, over at the 116 even level. What's that telling you? Well, we know the market's done more volume at 116 even than they did below. So this is a bullish curve with what? Increasing momentum. So what would you think an RSI would do? It would be moving up. What would you think stochastics would do? Well, they would have bottomed, then they started with a moving up. This is how, what do you think momentum would be? Would be increasing. But when you look at a picture, it's much quicker than looking at a traditional technical analysis. Plus, we'll tell you where you begin. Your stochastics have just been moving along and along, and you try to change different periods. We don't have to do that. Okay? So this is a curve with an imbalance. Now, as we said, there are three variables of central tendency: mathematical mid-range, the longest line, and the TPO balance point. The next few slides are just going to be definitions of what we talked about. And I'm not really going to go over them. I'm just going to go through them quickly. You can read them. Here's the longest line, or high volume price. Remember, mean, mode, median, no difference. And here is our TPO balance point. Now, this is kind of important. This is, well, they're all important, but this one is actually a tougher concept to grab. But this is really our timing mechanism. Okay, you now see the current picture, which is the spiders, SPY, and we have added in, as you can see, a third indicator. You have our mid-range at 112.24, not surprising. You have our high volume price at 113.88, but now we have this thing called the TPO balance point. And what is that? Well, that is the point where you have just as many buyers above. You have 100 million buyers above as you have 100 million sellers below. So any place of time as you sit here, there is a point on that particular curve over that particular time frame where supply and demand is zero. Okay? Wow, let me think about that. I'll try to give you a quick little diagram. If, for example, the TPO balance point was down here at 113.04, as I just indicated. And as you trade up at this high volume price at 113.88, as you trade up there, what happens to that TPO balance point that's down here at 113.04? It begins to move higher. Okay, this is a bullish curve. It shows a higher objective. And every day the market trades, this TPO balance point moves up. And this is also what you're going to buy against, because that's your 0 point. And it's like the marching soldier. This curve has to make its upside objective before the TPO balance point gets to that high volume price. Because once it gets to that high volume price, what does that tell us? That the curve is now in a 50-50 position. We get out of our positions and we stand aside. It could still rally to our objectives, but that's not the issue. The issue is, statistically at this point, we're going to do what? We're going to exit the trade. Okay, so it takes a little while, and I hesitated so you can think about that a little bit, but that is a key point and one of the best timing mechanisms we've ever found in the markets. Okay. Joe, you talk about these objectives and going to these second standard deviations. How do you do that? Okay, it's very simple. The longest line in this case here is 114.06. The mathematical mid-range is 114.03. You take the difference, that's 3 ticks. You multiply it by the magical number of 2. 2 times 3 equals 6. This bell curve shows you a 6-tick new high to 114.18. Okay, so you take the 6 ticks and you add the 6 ticks to this high up here at 114.12. Now, when you do, now that we have this objective of 114.18, you say, okay, Joe, how do you trade that? Well, we're going to show you. We have our new objective, 114.18. Let's take a look at it. Here's 114.18. There's our new objective. Well, what's our low? Well, that's easy. That's 114.03. Where would you get that, Joe? That's mid-range of the curve that we just showed you. So once again, that's the new 0 point is 114.03. So now it's just easy math. What's mid-range between 114.03 and 114.18? 114.10 plus. Well, gee, now, because I'm a supply and demand guy, I'm looking at the 15% skew to the upside, 15% tail in the downside, and the 70% body. And we know what that looks like. And those are the numbers. Hence, when we would trade this market, we would try to sell in the 15 plus to 18 level. We would try to buy in the 03 to 05 level. And we would expect the market to go sideways in the 10 plus level. All right? Okay, what does it look like on a bearish curve? A bearish curve is just the opposite. Mathematical mid-range is at 98.55. The high volume price is 52. 3 tick difference. 2 times 3 equals 6. This curve shows what? A new low, a 6-tick new low below our 44 level. This curve right here now shows 98.38. What do we do? Same thing. 98.38 is the objective. Our 0 point is mid-range at 55. Now it's just adding math. So when you see a buy and sell area for us, we're buying and selling in that 15% area and selling in that 15% area. And we say to ourselves, we know where the market should go sideways. Okay. It's going to take a while for you guys to get that, but we got a lot to get through, and I want to get through into your markets. So you can certainly go back and ask any of our guys any questions at a later date or on the Q&A. Anyhow, I think it's important for you guys, for everybody to understand that traditional technical analysis you currently use is very good. And all of this is probability theory. And it all comes from the same statistical measures I'm showing you. But we're showing you it pictorially. And not only that, the bell curve methodology gives you a 360 view. Each of these gives you a view, but not 360. All right? So I'm going to try to kind of compare and contrast for you the different analysis and show you the bell curve alongside it. Just see here. Now, the other thing is when you look at these traditional analysis, there's a couple of things that you don't know. Is when do you start? Where do you start? Where do you begin and where do you end? And this all comes into the idea of 0 and infinity. Okay, here's a curve that has an imbalance that we've already seen. All right. Now, what we're going to do here is compare and contrast two curves. On the left, you're seeing the March S&P, pretty current. It's actually current as of like a couple days ago. And there it is. You can see on this curve, you have your mid-range, and I'll put a little arrow in, at the 1794 level. Okay. You have your high volume price up at 1836 and your TPO balance at 1812, mean mode median. On the right, what do we have? The Bollinger Band. Okay, what's that? Well, that's a moving average, which is the blue line. And what's the moving average do? Moving up. What's the bullish? You have the bullish bell curve on the left. What do we have there? High volume prices are moving up. Those little distributions, as you move up, get bigger. Taking a look at the Bollinger. Look at the bands. When we're up at our highest volume area of 1836, look how wide the Bollinger Band gets from here to there. Why is it getting so wide? Because it's getting ready to make a large move. Okay? That consolidation up top is getting to 0. That thing is beginning to show what? A new objective. I showed you how you get objectives. Where do you buy against? You buy against that 1812 TPO balance point. Okay, you use your 15%. That curve right now shows something in the area of like 1938, which happens to be one of our current objectives. All right? Good technical analysis have similar things. Okay, here is the bell curve, same curve. We're looking at the March S&P versus the ADX, which is just a trending analysis. Now, let's take a look. You see the bell curve, the high volume price at 1836, that sideways move. Where's the ADX? Dropping extremely low. Taking a look at it right here. Why is it dropping low? When it's low, it's getting ready to tell you, hey, guess what? A large move is about to happen. That's what you see when you look over here at the bell curve. There's your high volume price. Here's your TPO balance. They're very close, telling us that that move should happen very soon. If you keep trading up here and you don't make a high and that TPO balance reaches that 1836, guess what? It's 50-50 which way. Currently, we are bullish this curve, expecting it to make its move up to the 1932 level. What tells us we're wrong? Sitting below that 1827 level in that lower distribution, which runs 1827 to that 1850 area that I just marked there. So it's getting ready to trend. ADX says the same thing. We're going to give you timing. We're going to give you pricing objectives. You're not going to get there anywhere else in the ADX. You get part of the story. Here's stochastics. Well, you can see you have a nice bullish curve on the S&P. Over here to the left, high volume prices are doing what? Moving up. They move up. They move up. They move up. Bullish curve. What happens in stochastics? Well, it just stays way up at this very high level and says at some point we're going to go down, some point we're going to go down, some point we're going to go down. Okay? Not really all that helpful. But what we do see now is stochastics are coming into an area of being flat at 50, saying, hey, you should break. Well, why? You can see it over here to the left off the supply and demand curve and bell curve. Once again, good statistical analysis have many things in common. Okay. Now what we're going to do at this point is I'm going to kind of review a little bit here the S&P, gold market, and the dollar-yen market as we currently see it. All right, let me just, okay. Now, we're going to start off with the S&P market. I showed you how we do our calculations. What you have to the far left, and if you look at the very bottom, you see December 94. You can see below that March 09, and you can see Feb 14. Okay? The dates down there tell you when these things begin. So currently, if I look at just this 94 curve over here, you can see these big green lines. Now what they're showing you is where mid-range is. This curve from December 94 using the same natural statistics that we have showed you shows an objective currently of 1770. Okay, so right in here. Now, the curve over here in the middle is the March 09 curve, okay, as you can see there. That March 09 curve was the low retracement. Now, you may not realize it, but what it did was when it dropped to the high volume price of the distribution below, which happens to be right here. That's very normal. What kind of a normal drop is that? That's like using Gann or using wave theory. That's the 618 or the 75% retracement. We use the high volume price of the distribution below mid-range. Then you ask, well, what's the objective of this March curve? Well, there's your mid-range at that green arrow, as you can see. And then what do? Is we have the difference between that high volume price. And lo and behold, what does that curve show? This guys who have been with us know that shows our top objective in the market of 1950. Hence, currently in the S&P in our long-term view, that is the selling area, 1750 to 1950. And we've been in this uptrade since March 09 because the high volume prices have moved up, and mid-range and the high volume prices of the 94 curve have moved up, as you see there. Okay, now we show you two different curves. One's going to be October 13. You can see that down here. And one is the next curve over here, which is sub 14. Now, the Oct 13 curve, why did it start? Why did we use that curve? Because it went to 0 off of our Sep 9 of our March 09 curve. And we take a look at that and we say, okay, what's the objective of that October 13 curve that we have there? Well, when you take your mid-range and your high volume, multiply it by the magic number 2, we're going to get a curve that shows going right up to 1915, right in our seller area of our longer term. We then look at the curve here from October 14th, and we say, well, what's the objective of that curve? There's your mid-range, is the green arrow. Here's your high volume price at the 1835 level. What's its objective? Its objective is roughly 1930 to 1932, right in that area, which is right into our 1950 long-term objective. So we're following these up moves. And you say, but Joe, you're really looking to sell in the intermediate and longer term. That's correct. In the longer term, we're looking to sell, but in the intermediate, we still have outstanding upside objectives. When one of these curves begins to fail, and in this case, it would be the February would fail first, we then could potentially see a domino effect where the longer term guys have begun to come into the market. Okay, now, this is currently where we are as we sit here today. As you can see, once again, down below, you see we have the Feb 4th curve, which I'm outlining. Take a look at those numbers down there. And that's a bullish curve. You see mid-range is at 1808. And you see you have your high volume price over here at the 1842 to 1834 level. And now what this market's done is made another high volume price up at 1872. So what have we been doing? Well, we were buying for a move up to this 1870 level. We were able to get out. We sold. We looked for a move down to the high volume price, TPO balance, which is the 1832 to 1842. The market moved into that territory. And this almost sounds surreal. We then said, hey, look for the move to get up to the 1872-3 level, and then expect a drop. We're anticipating a short-term range now of 1832 to 1872, no magic, sideways, and then a new break. Well, with Janet Yellen today, I think the last I looked at, we are now down to 1855. So we're right back into guess where? Basically, fair price of the range that we've been looking at with all of our short-term guys. Okay, let's move on to gold. Here's our gold curve. Gold, you may sit here and say, what the heck is this? Well, if you look below, we got 1980 down here in the bottom. We got 2004. We got a 2012 curve and 2013. The curve to the far left from 1980, that curve was how gold was. That curve actually showing gold going to minus 120. Gold couldn't move to minus 120. So it took 20 years of sideways move. Even though we had great inflation, gold didn't go up because the supply and demand gold said I'm going negative. Can't go negative. So you spent basically 20 years of going sideways around 360. We then calculated is when did supply and demand of that 1980 curve go and change? Well, we said it actually finished right here in 2004. Okay? And So I think we're only guys in the world that have this 2004 curve. After it reaches its upside objective, we say, hey, here's our buy area. Where's our buy area run? Anywhere from mid-range, where that green arrow is, to the high volume of the distribution below, right down here at the basically 900 area. So far, what has the market done? It has come down to our mid-range area and began an up move. Now, is this the beginning of the move that shows much higher prices? Or do we still have a shot to go down to 900? That's the question we're looking at. How do we come up and answer that? What's our key curve to look at right now? That curve is right here. That's that February 12th curve. That's the down curve. And it's going to do what? It's in the competition against this up curve from 2013. Here's that 04 curve. There's the Feb 2000 curve and the up curve. Now, what do we have here? On the left, you have that February down curve. Now you also have our up curve that we were talking about, and you have that TPO balance point, which comes in at this critical 1340 level. Okay, above it, we're going to get short covering up to mid-range 1440 and higher. Below it means we're going to start a new downtrend and go into the current low, and possibly low is 900. So right now, where did we stand up stopping? After I watched the Janet Yellen finish, we basically stopped right around our TPO balance point in this 1330 to 1327 level. So we're going to watch that closely to see what's the next large move. A continuous short covering or a new down move. Once again, all we're using is a supply and demand methodology. We have a bell curve. Okay, and the last one I'm going to get to is dollar yen, which I've already talked to you about. So I won't spend as much time on dollar yen. On the left, what do we have? The balance market. We started from zero. We're zero right here. And what did happen from zero? You start the new 07 curve. That curve goes down, reaches its objective. We have a rally back up to not only mid-range, the high volume and distribution above, right there. And now we begin a new down move. Here it is, a little more granularly. Here's your November 13 curve. Here's the curve from the top down from Jan 14. Right after Janet Yellen spoke, I think we rallied right back up to our TPO balance high volume price in this 102.60 area. So once again, this comes at a crucial level. Holding above that TPO balance will show some short covering. Staying below it will keep this thing in a very bearish setup. We'll take a look at that once again, a little more granularly. The market has now rallied all the way back up to the 102.50 level, and that'll be key in the next few days. Okay, that actually ends the current thing here. Tom?
Okay, thank you, Joe. And see if we have, if you have any questions, please go ahead and enter them now into the chat. And so as you can see, the announcement here on the free 30-day trial, as well as I mentioned that everyone who's registered will receive an email link that will take you back to the, to see the recorded webinar again. And so let's see here. Okay, Joe, well, it looks like your presentation was very thorough, and almost everyone stayed through the entire thing, so we really appreciate your time and effort on this. And so, again, people, I want to say thank you for attending this webinar. And as you can see here, the contact information for more information is available. And appreciate your time. Thank you, everyone. Goodbye.
Thanks a lot, Tom.
Thank
Take
you,
care. Bye.